Welcome back to the channel. My name is Zevi. In today's video, I want to talk about what monthly income do I need to qualify for a loan. Now, let me be clear about this. I think the best way to handle this piece in the transaction is to work through a loan officer, somebody who knows how to run income. However, there are things that I can point out to you that you could try to figure out if this is something that you could do for yourself, just to get a basic understanding of where along the spectrum you would be able to afford. Now, mind you, the reason I say that is because it would be very difficult for somebody to want to move if they knew that there is no way they could afford something that is, say, at the bare minimum of what they would consider as a home that they would transition to from renting. And that's basically the premise of the video if you want to try to figure this out for yourself. Now, mind you, my name is Zevi. I'm an owner of a company called Brook Inc. in Woodland Hills, California. That's what I do for a living. So if this seems a bit odd or complicated, just feel free to give me a buzz, 818-697-8220, and I'll be happy to help you out with it. All right, with that, let's get started with it. So what is the monthly income that is required to qualify for a loan? Now, the short answer to that is basically whatever your income is, you could use up to 50% of it to qualify, all right? So for somebody who works at a company, that would be your gross earning. So whatever your gross earning is, you basically take that, divide it in two, and then any housing liability that you have, including anything else that's going to pop up on your credit report, cannot exceed half of your income at best to qualify for housing. All right. So to take it a step further, and this is the reason why I think it would be the wisest thing to consult with a loan professional about this, is simply because there's a lot of things that could be left out of the equation. Let's talk about them. When I'm shopping for a property, if I put down less than 20%, that means I have mortgage insurance. Now, mortgage insurance is typically calculated at anywhere between 1/4 to 0.5% of whatever my loan amount is, right? I take that, I multiply it annually, divided by 12, I add it into the monthly payment. You wouldn't want to leave that out because that's another monthly obligation. In addition to, if you have property taxes and insurance, that's important. It's a part of your combined payment. What about if you're buying a condo? A lot of times people get confused. They're like, yeah, I was qualified for $400,000. For a house or for a condo? Because if you're qualified for a condo, then the loan officer already took into consideration that there's probably anywhere between $300 to $400 minimum HOA payment. All right? Now, what if there's other things involved, like a master community might have like a Melrose fee, which is like a builder's bond that they pass on to the buyer. And it's done for like a number of years, or like a solar purchase or a lease that is said to go on for the next 5 or 10 years. That's a part of your housing monthly liability. So you got to make sure to take all these things into consideration when you in fact factor in the housing liability as being 50% or less of your take-home income. Now, in addition to your housing, there's also your credit liabilities, which means that if you owe a payment on a car or a minimum payment on a credit card, you have to consider these payments as your monthly obligations, all right? So basically, when we size up a borrower, we look at both their front end and their back end liabilities, meaning that we look at whatever it is that the housing is going to be, and then we factor in the liabilities that are coming in from their credit report, okay? Front end being only housing, and then back end being everything else included into it. Now, if you want to figure out the ideal purchase price and down payment and work backwards, that would be a great way to do it. So the way I would do it is figure out, okay, I wouldn't move unless I was able to buy this property, let's just say for $400,000, and I know I have 10% down payment, so that would be my minimum. So you could work backwards from there, plug into a mortgage calculator, right? 400,000 purchase, 10% down, that's 40,000. So my loan amount is 360. You could benchmark it in today's world at 7% interest rate. You get an idea of the payment, put in your property taxes, your insurance, your HOA if you have one, anything else that's tied to the property is a monthly obligation, your minimum credit card or car payment, meaning revolving or installments. Now you have the full shell of what your monthly obligation is, and you got to make sure that it's less than 50% of whatever your take-home income is. Now, I know this video is a little bit involved, but I just want to give you a picture of what the qualification behind the scenes, what it actually looks like. It's something that if you've done this for many years, like myself, you could do it very quickly, probably within 30 minutes or so. You could figure out if somebody is qualified, sometimes even a lot quicker than that, all right? So if you're on that boat, you're trying to figure it out, you're not sure whether you want to try to do this yourself or have somebody else look at it, or just have a conversation about it, you're welcome to give me a call, 818-697-8220. I'll be happy to look at it and let you know what I think, all right? I do appreciate you watching this, and if you like this video, then please give it a thumbs up so other people like yourself can find it on the web. If you like to see more videos like this in general, then feel free to subscribe to my channel. I appreciate you being here. I appreciate you watching this, and I look forward to seeing you again on my next video. Take care.